I'm in 40 different deals right now, and I've got 2 of them that are a little upside down. So, maybe 5% in my experience. I haven't had any capital calls from the groups that I'm involved with. If you have a $500,000 that you're going to drop into private real estate, don't try to pick the winning pony and put the whole thing on it. Pick 5 winning ponies and mitigate the risk. Money goes where it's treated well. So if everything's lined up appropriately, that's going to be a good place to have an investment.
Dan, Tyson, right? I'm sitting in your farm when we met at a small weekend event from Tim's group, and now here we are, and now we're talking about buying something together and partnering up because we all got along with each other. We found out that we could tolerate each other and we trust each other, and it took a while, and we've kind of chatted and grown that relationship. So, because they're an investment, right?
Right.
They're quite the investment. You're going to spend quite a bit of money.
Welcome to The Big Break Show, your go-to podcast for real estate investing, business acquisition, mindset, and lifestyle. Now, let's dive into Season 2 with your hosts, Rafa Loza and Dan Tollins.
What's up, everybody? Welcome to yet another episode of The Big Break Show. And today we have a very special episode because I'm actually sitting in my good friend Tyson's house out in Dahlgren, Illinois, and Dan's out at his hotel. So we're trying to do sort of a semi-live recording today. And I'm excited because Tyson and I have become really good friends over the past year, and he's done some great stuff around real estate and in the medical field. So we wanted to have him on and have a bit of a conversation about his life, what he's been through, his experiences, and hopefully you guys can learn and pick something up along the way. With that being said, Dan, what's up, brother? How are you? How's the hotel going?
Oh man, it's going great. Another full weekend, and knocking out some things. Got a couple issues with parking, but yeah, no, it's going really, really well, and rates are rising. Occupancy is up, so it's going well. It's stabilizing. You know what I mean? So fortunately, we've got another one in the works that we're really pumped about as well. So it'll be nice to have things rolling.
Hell yeah, dude. So talk a little bit about out there and the lifestyle and what you're going through. Because I know yesterday I saw your Instagram and you looked like you were having a blast out there with the weather.
Yeah, I mean, that's the whole reason we moved here coming from Charleston was being able to have affordable access to the water and give our boys a lifestyle that we wanted for ourselves as children. And, it's just like our 15-year-old, he leaves the boat in the backyard and goes out through the canal, and he goes about a mile up the creek and goes to his girlfriend's house. So then they go out and go fishing and come back and eat whatever they catch. And I mean, it's beautiful. And then he comes back to the house and gets on his bike and rides to the pier and goes to work. You know what I mean? So it makes things a hell of a lot easier when you got stuff like that set up for your family, or we're able to ride our bikes to work, or just all those wonderful things. The water is yesterday it was clear, so you're out here messing around in teal and clear water. So makes it all that much more enjoyable.
Yeah, I love it, dude. I got to tell you, we're out here in the woods. Tyson's got some beautiful land out here. And, man, it is just an awesome, awesome place to come out and hang out and relax and just kind of kick your feet up. Going from when I was with you last week at the beach to here, it's just like one extreme, right, of Mother Nature, right? The beach with the water, and then coming here, and it's like the forest, the greens. So it's very cool to be able to experience that. So with that being said, Tyson, you want to tell us a little bit about your farm here so we can get started?
Sure, yeah. I bought this in 97, and I've just done a ton of work on it, and we've planted literally hundreds of trees, primarily for the wildlife, but with tons of apple trees and pear trees and plum trees, as you've seen, and put in a lot of food plots for the wildlife. So it's just a wildlife mecca, just a cool place to come down and hang out.
Yeah, so we've been chilling these windows behind us. Typically, these chairs are flipped around, and dude, I've seen all kinds of cool critters: turkeys, deer. We saw a possum, a raccoon, squirrels, a mole, a little mole rat. All kinds of crazy stuff that you never see, right? We were talking about the little lightning bugs last night. You don't see those in California, and there's a ton out here at night. It's like they're just shining up the forest. It looks beautiful. So, Tyson, before we get into it, let everybody know who you are, what you're about, what you do, where you came from. Go deep, go back. Tell us your story here.
Yeah, my name is Tyson Cobb. I'm a semi-retired orthopedic surgeon. Grew up in Texas on a farm and ranch. Rodeoed professionally before I went to medical school. So have a very varied background compared to most orthopedic surgeons. And I did my training at Mayo Clinic in Minnesota, so that was quite a switch for me, going from Texas to Minnesota. And practiced here in the Midwest. And bought this farm in 97, lived down here for a few years, and then moved into the Quad Cities and practiced with the same group there for 20 years. And 2019 decided it was time to slow down a little bit for orthopedics and back down to operate 1 day a week. And the rest of the time, I'm investing in real estate. So do real estate pretty much full time now. And do a lot of syndications. When I first started, I went in triple net. And that's kind of a easy place to get started because it's pretty simple math. 20-year leases that are guaranteed. So it's I think it's an easier space to start out in. And then moved into syndications and multifamily, self-storage, car washes, just do a lot of different stuff now, as you know. And just having a good time with it.
Dude, you've done a ton. You've done a lot of stuff. You know, when I first met you, I had no idea about your medical background. So then I started getting to know you, obviously, and I've actually gotten to see you now in action, which is awesome. I appreciate you letting me see that. Talk a little bit about how that transition went, right? Danny, do you want to jump into it, talking about his transition from?
No,
I think
you're leading right into it.
Yeah, let's do it. I want to talk about a little bit of your transition from the medical field to real estate investing. You know, going from just work and grinding, because I could only imagine it was probably a grind, right? Nonstop hours, working late. I know we've talked about it briefly. So one of the things we talk about on the podcast is a lot of it is mindset and shifting and going from 9 to 5 type of work and going into entrepreneurship and doing your own stuff on your own time, which in some cases becomes more hours for most people. I'm assuming it's kind of slowed down a little bit for you. I don't know how that might work, but talk a little bit of the transition between going from the medical field and doing surgery full time to coming in and now just being a badass real estate investor. How was that like?
Yeah, so it was an amazing shift. And as you might imagine, after being with the same group and doing the same thing for 20 years, it was, it was a little bit anxiety provoking, I would say, making that transition. Some days I would think, boy, I feel like I might be getting ready to go off a cliff here, right? So that was a little tough, making that change. And but it was one of the best things I've ever done. You know, I went off call, so that slowed things down, gave me a lot of freedom. And we travel a ton now. We go to a ton of real estate meetings and travel around to look at real estate. And as you know, when you get in these different groups, you start hanging out with people that are moving and shaking and doing things that are very different than maybe the people you would associate with at home. Not that they're not good people, but they're just not moving at the same velocity as these people are. That intentionally join groups to learn and be better. And that's for sure, one of the life-changing things. But as you mentioned, getting your time back and living life by design is a big, big deal. And, I think one of the things that I learned very young in life, growing up on a farm and ranch, was just learned a pretty strong work ethic. And you combine a strong work ethic with a limitless amount of orthopedic problems that need to be taken care of, and you wind up with a schedule that is pretty overwhelming and pretty much locks everything else out of your life. It destroys relationships. I was out of shape, didn't have hardly anything going on outside of work, and then transitioned into this lifestyle, which, as you know, is a lot more balance, and everything gets better when you can live life by design and be intentional about things. You have to have time to think, though.
Wow. So what you're telling me is that you didn't have a six-pack while you were being a surgeon like you have now.
No, it's kind of hard to keep that balance when you're working those hours.
No, so, all jokes aside, it's kind of crazy. Why real estate? What made you go from, because I'm sure you were doing very well, right? The hours were crushing, you were being overwhelmed. But there's a million things you can get into. Why did you choose real estate, right? Instead of like stock options or investing in I don't know, these other million things, Dan, that people invest in?
Yeah, it's a good question. I think God just leads us into different seasons in life. And, it wasn't just something I woke up one morning and said, I'm going to do this. It didn't happen like that at all. I just was actually working with a guy who was doing the triple net investing. And, he just taught me a little bit about some of the advantages of investing in real estate, net worth growth, tenants paying off your property for you, taxes, the list goes on and on. And so I just jumped out and bought one, and he kind of helped me with that. And then the second one, he and I actually JV'd and bought it together. And then just started listening to podcasts. I just wanted to learn more.
Yep.
And I ran into Tim Brott's podcast, and, we wound up in the group that we met each other in. But it just, one thing leads to another in life. And as I mentioned earlier, if you're intentional about growth, it happens.
Yeah.
Yeah, I think over the last couple of years, just being a part of that legacy group, that's where all three of us met. And, I think there's just a lot of really just solid people in there that are intentional. And the ones that aren't, they kind of weed themselves out, right? But, the ones that are ready to take action, they're networking with people. They're trying to figure out what's their strength, what's other people's strength. How can you kind of, combine forces? And, I think we've got a good synergy here between the three of us that, eventually we're going to do something. We've got some things cooking, right? But, the time's going to come. I think all of us really understand what we're best at and, really learning how to lean on one another for their strengths. And Tyson, you're in a ton of groups. I mean, can you speak to that a little bit about just trying to figure out how to best use your time on those trips to really figure out, kind of like speed dating, right? To figure out who you think you could get value from or who you think you get value to.
Yeah, for sure. I started with Tim's group, and as you guys know, it's a very active group, and we love all the social programs, because it adds so much interaction time, right?
Yeah.
So some of these meetings you go to, and you have a little interaction during the day, but by and large, you're captivated by whoever's speaking on stage, and then maybe there's just a little bit of cocktail hour or whatever in the evening, and then for some of the groups they don't do too much after that. But Tim does a fantastic job of putting really nice social programs together. So the amount of interaction you get is magnified substantially through those types of events. But yeah, each group kind of has its own personality, and it's worth taking some time and kind of exploring some of the various groups. And, you learn different things and meet different types of people. I think I think all of these groups will take on to some extent the personality of the leadership. And the interesting thing that I've noted on the ones that we're involved in, all of these people are, very motivated to give back, not only give back to people like us that come into the group and are wanting to learn more, but also just give back to society. So all of these people have, if you investigate them a little bit, you'll learn that they have programs to help those that are less fortunate, and they attract people that have a similar mindset, I think.
Yeah. What are you looking for? Every group is different, and I know you're in a ton of them. We talk about this all the time, but do you look for anything specific per group, or are you just going out there to network and hope something comes out of it?
As I investigate a group, I want to know about the character of the people that are running the show, because as I mentioned, they'll build people around that. So, when people like Tim and Rod Cleef are talking about, giving back and the importance of that, people that don't have that mindset and don't have that character, they're either walking out the back door or they're looking for it because it doesn't resonate with them.
Yeah.
And, the people that are, in Tim's group, because all three of us are in Tim's group, everybody's hard chargers, they're intentional, they're motivated, they want to do things. And, like you and I we're constantly talking about, things that we'd like to get involved in and investigating and taking the next step, making the phone calls. And, I keep saying being intentional, but it's so important, to move on to the next level.
Yeah.
How much would you value, having, basically you're filtering out the general public, right? To be able to have, the folks that are in the rooms that you can wait, you can discuss these options and really have a valued opinion kind of coming back to you, right? So if you're looking at something hard, but you don't know who the hell you can talk to about it, but if you're leaning on somebody that you've been in some of these groups with, that you feel like that you're going to get some decent feedback from.
Yeah, for sure. I mean, the essence now, I mean, having been in these groups for a while in multiple groups, I don't think there's anything that I run into in life or business that I couldn't pick up the phone and call multiple people and either get the answer or find out who I need to talk to get the answer. And that's incredibly important because particularly as you move into new asset classes and you do different things, you're going to need some help and you're going to need some advice to transition and being able to pick up the phone call and make a phone call is super important.
Yeah, there's a part to that too, Dan, because we talk a ton about masterminds on the podcast. There's a part where if you're not intentional, I mean, you can join a million groups and show up and go through the motions and be the same person. And yeah, you're still going to learn, right? And you're still going to pick stuff up. But if you're not intentional about what you want out of each group or out of each meeting, because each group is not meeting every single day, right? For example, with Tim's group, we meet up, 3 times a year or something? And yeah, as much as the day events are fun, at some point, like to me, it just becomes, I don't want to call it redundant, but it's like I've just heard it so many times from so different places. I actually go to meet the people to see who I can resonate with, who I can talk with, who I can add value to, who I can have a conversation about life, health, fitness, business, real estate, short-term rentals, vacation, right? And so that's kind of my thing now is I go to these groups for the social events because of the networking more than the actual day speakers, so to speak, right? And don't get me wrong, I learn a ton from that still, but the real value for me comes from the relationships. I mean, look, right, Dan, Tyson, right? Like I'm sitting in your farm when we met at a small mastermind. At one of these small weekend events from Tim's group. And now here we are. And now we're talking about buying something together and partnering up. Dan, we're talking about buying something and partnering up because we all got along with each other. We found out that we could tolerate each other and we trust each other. And it took a while and we've kind of chatted and grown that relationship. So I feel like it's something what I'm trying to clarify here is, you got to be intentional about if anybody's out there on the fence and you're looking at a group that you're like, man, I want to join because they're an investment, right?
Right.
They're quite the investment. You're going to spend quite a bit of money.
Yeah, heavily. I mean, some of them, like Tim, he does a great job making it somewhat affordable, offering monthly payments if you don't have the 25 or 30 grand, whatever it is, 15 grand, I don't know. But, I think there's a certain level for us, we're a little bit further along in the journey, right? But for folks that are just getting started, I think it's important to try some of the one-off events and not just go into something that's in your town, right? I think traveling, to get to an event, whether it's, driving or flying, whatever. But I think that kind of pushes the envelope where you really are invested and financially and your time, and then go try it out and see if it's the right group for you. And then if it is, then you join the year-long thing or multi-year. But that was like how we did it. We went to, I don't know, 5 or 6 different events with different folks. And, eventually we just resonated the most with the legacy group and have formed just great relationships. But, for some people, it's not the right group. And, other people that are trying to get, more into wholesaling or self-storage or RV parks, there's different groups for that, but for what all we're doing, that's, really what worked for us.
Yeah, I mean, now we're in a business buying group together, right? And that's kind of like the next level for me. Now I'm learning something completely out of my element, completely different, putting myself out of my own comfort zone to learn something new. So, yeah, I mean, look, point being is try what works for you. Make sure that you enjoy it. Make sure you like the people. Make sure you can learn something from the people and find a relationship that you can grow with. I mean, I've known so many people that are buying stuff together from that group specifically that they met there. I'm a perfect example of it. So let's transition the conversation a little bit. Dan, if you're cool with that, I want to ask a little bit about, I actually want to go really back and ask you some questions about because I know you have like a very cool background that you kind of glazed over, where you were like a cowboy, the rodeo, then a surgeon, then a big time real estate investor. Like you've done a lot of cool shit over time. We'll get back to that if we have some time. Right now, what I want to talk about is Timberview Capital. I want to give you a little bit of time to highlight that because I know that's a big part of your real estate investment journey and a big part of your business. And not only that I want to know about it, but one of the biggest struggles that people have in real estate, and Dan, correct me if I'm wrong, and Tyson, correct me if I'm wrong, but deal flow is everywhere. The hard part is being able to get the funds at sometimes, right? Obviously, everything comes in segments, but is getting funds or capital or being able to put that money together, right? A lot of people out there think that in order to get into real estate, you need to use your own money and you have to get going your own money. And that's great because that's how I did it, Dan. That's how you did it. But there's a point where at some point you're going to need to be able to raise capital, and you've just become an absolute master at it. So that's kind of where I'm going with Timberview Capital. Do you want to just kind of give a brief overview of what it's about? But then once you do that, get really into like what it is and how it was for you to transition into raising capital as opposed to finding the deals and doing them yourself.
Yeah, so Timberview Capital is, it's basically just a network, and we started as a group of surgeons, and I can bring some value to other people because we're in all these groups that we've been talking about, and so we have access to a lot of things that most people don't, and we have access to things that I didn't have 5 years ago. Super savvy CPAs, attorneys that specialize in different areas, people that have been vetted by, some of the biggest and most successful entrepreneurs on the planet. And most of these groups, they keep lists of these people that, they've vetted and make their contacts available to their students. So that's one of the things that I bring. As you mentioned, deal flow. We get a ton of deal flow because we're in all these groups and networks and we're traveling all the time. And when I first started this, finding good deals was tough.
Yeah.
And, we went through a phase where, 30 buyers would show up and it would wind up selling for over ask. And at that time, I was kind of in acquisition mode. I love doing research. I've done a ton of research in medicine over the years. And so I thought acquisition would be a good fit for me because it's a lot of research. You're just researching the property, you're researching the area, looking at the growth and job growth and so forth and so on. So that was fun for me, and we were putting in. I was working with Nick Burton with Tim's group, putting in ton of offers, and they were trying to find properties that still had a little meat left on the bone. That you could basically pick up some equity, just purchase price, if you will, and then add to that with value add. And it's one of the things I love about real estate is you can create wealth out of just thin air if you look for it and you think about it. There's so much opportunity out there, but I'm getting off course here just a bit, but. So I was putting in tons and tons of offers, and at that time, as I mentioned, you couldn't find good deals. I mean, most of the discounted deals were problem children that you didn't want to be involved with. Just tough properties with tough tenants, or some type of structural problem. Everything was a bit of a mess, and that was discounted. And the stuff that was really nice properties, a lot of them were selling for over ask. And I had just gotten into a deal with Gabe Krasinski, who's also in Tim's group in San Antonio, and I found a property in Davenport that was 85 units that I knew the guy that had it was wanting to sell it, and so I reached out to Gabe because we just had done that deal. I invested as an LP, and I said, "Hey, Gabe, would you be interested in helping me syndicate this deal?" And he said, "Sure." So we worked on that for probably 6 weeks and wound up walking away from it. And he said, I can tell you, you've got an interest in doing this GP thing. He said, "Why don't you just join our team in San Antonio that you just invested in?" I said, "Well, that'd be great. What do you need help with?" He said, "Can you raise capital?" And I'm like, "Gosh, I don't know, Gabe. I've never even thought about raising capital." I said, give me a little time here. So I just jumped on the phone and called some people, and I'm like, this is something I'm investing in. This is the reason I like it. I think it's a great investment, and they still have a few spots left. And a week later, I was done. And about that time, I showed up at a Rod Cleef meeting in Denver, and he said, there's a lot of moving parts in these syndications and a ton of stuff that you need to try to learn and be good at. But he said, you only really have to be good at one thing because this is a team sport. And the light went off, and I went home and shoved all the acquisition stuff off the desk and just turned down capital raising direction. And that's been a good move for me. But you'd ask about Timberview Capital. Early on, we didn't have good deal flow, and we didn't have enough capital to close things. And it wasn't uncommon to try to get involved in something that we just couldn't close. We just didn't have enough capital to bring it to the table. Somebody else would swoop in and pick it up. And so I learned early on the size of your network is exceedingly important. So just went to work recruiting people and building the network, and that's worked well over the years. But it's it's an interesting phenomenon making a transition as an orthopedic surgeon to entrepreneur and real estate investor, because orthopedic surgeons tend to be kind of a zero-sum game minded group. And I think that's because we compete so ferociously in making our way into medical school and making it into residencies. And you had to be at the top of your class. And if you're going to be at the top of the class, somebody had to move down. And so it creates a little bit of a zero-sum minded game, whereas you move into these groups and you have people like Tim Bratz who loves to say, you getting sunshine on your face doesn't take any sunshine away from me. And, that's the way people think in these groups. We're all in the boat together and it's going to rise, and, we're all going to do well. So, somebody doesn't have to lose for somebody else to win. And I think when you have that mentality, it's so much easier to create large networks because, you're given so much and people are blessed to be part of it. So I think that's one of the reasons that these groups grow so well when you have the right mindset, and you learn the right mindset by hanging out with these groups that we're in.
Mm-hmm.
Hey Tyson, when you're talking about raising capital, how many times have you come across where somebody's just might not be a good fit, where they might be a little too needy, and then also touch on like how important it is to really paint the picture and have realistic expectations of how long folks are going to have to leave their money in a deal, and not overselling or overhyping, or hey, we're going to start paying our pref, within the first 30 days, you're going to have your money back in 12 months. And, then people put their money in and then all of a sudden there's no pref, and then they have to leave their money in for, 3 or 4 or 5 years.
Yeah, so that's super important. And when I'm first talking to someone who's considering joining the group and investing in some of our deals, we have to talk about those things. How long you want your money locked up? Because there are investments that you can get involved in where it's going to pay a pref for a short period of time, but that's not your usual real estate investment. The usual one is long term, and so it's important these people have a long term mindset. And then the second thing that I like to talk about with a new investor is, do they need cash flow? And if they don't need it now, how soon are they going to need it? Because some of these deals that are heavy value adds, they may not cash flow for 2 or 3 years. So you're going to make everything on the backside. And, some of the development type programs, depending on how they're set up, could be the same way. And so if they're away from retirement and they don't need cash flow, but they're looking for extreme wealth development, I direct them into that pathway. If they're fairly close to retirement and they think they're going to need cash flow, then I'll direct them into a different type of investment. And if we don't have something that fits at the time, I just make note of what they're looking for and give them a call when we do have something. The interesting thing about raising capital, if you're getting into really good deals, there's a ton of people out there that want to do good deals. So it's, this isn't something that you have to sell people. You just have to present it so that they understand it. Mm-hmm. And that's, I have a lot of physician investors who were exactly like I were when I first started. And it probably took me close to a year to get comfortable with real estate investing. And so, you have to remember that when you're talking to people that are not experienced. they're not going to have a full appreciation of equity multiples, IRRs, and so forth and so on. And you have to break that down so that, they can wrap their arms around it.
Something else on the structure part of things, right? So, investors have different needs. And so let's say you're doing a raise and you've got somebody that, wants cash flow, or somebody that wants some pref, or somebody, that doesn't, they want to, defer it all. How do you separate who goes where, or do you simply have certain deals that are only structured a certain way, or is there a way to kind of blend all that together?
Yeah, so Ralph and I were talking about it earlier today. I mean, one of the things that's different about Timberview Capital is most capital raisers are working for a team, and so the deals that they bring to their people are basically whatever their acquisition team can take down, and they're eating whatever they kill. I'm not just part of one single team, so it's one of the beauties of being in a lot of these different groups. I meet a ton of different people, and it's very easy to join teams right now. So when you find a great team with a great property and a great location, the likelihood that you're going to be able to jump in if the timing's right is extremely high, because everybody's struggling to raise capital. So I think it's a great time for me to get involved in capital raise because it's a tough time to raise capital. So it's easy to find good deals now. So I'll typically have 4 or 5 deals going at the same time, and I try to make sure that they're going to fit well as a group. I have one right now that's a development fund that's set up to just strictly be an equity multiplier. And so the way that works, the people that design this this fund learned early on that in a development project, your velocity growth is extremely high in the first 2 years, where you're basically putting structure on bare ground and then filling it up with tenants, stabilize it, and then he sells it at that point with the goal of having a 2x equity multiple over a 2-year period, and then he rolls it into the next deal. And they have multiple deals within the fund so that they're able to offset the capital gains with the depreciation of the ones that they're holding. So the capital gains that they owe from the ones the properties are selling, they're offsetting with the depreciation of the ones that are still being held. And his goal is to do 5 rotations within the fund with a 2x equity multiple. In other words, they're doubling investor money every 2 years. So if you put 100,000 into the deal, 1 becomes 2, 2 becomes 4, 4 becomes 8, 16, 32. So his goal is to get a 32x over a 10-year run, which is a pretty aggressive plan. But for people that have a long runway, that's the type of deal I would direct them into if they're looking for equity multiple, because it's hard to find anything that's going to compare with that. Whereas another one we have right now is shorter hold time period with a development group in Sioux Falls that has a program that they've developed through experience and time, where they're doing 14 to 16 units per building. So it's a smaller build that they can complete fairly quickly. And they have these in different phases of development. And the first one's being pre-leased so that whenever they get the certificate of occupancy, the thing is leased up and they move people in. So they create cash flow a lot earlier than most development projects would. And, that's a good program for somebody that's, looking for some cash flow in a couple of years, but, doesn't need it today, but also wants to get a equity multiple. So, some of the people would refer to that as double dipping, where you're getting a cut of the equity and also a cut of the cash flow. And then we have a vineyard that's completely different than anything else. This long-term hold, they don't plan to sell. They hold back a little bit of the proceeds every year to go into a fund for the purpose of replanting when that has to happen, which apparently happens somewhere in 15 to 20 years, depending on the variety of grape. So this is going to be a long-term legacy wealth type of hold with grape farming, which obviously is completely different. And, to some extent, if you have different offerings relative to, that are varied relative to, is it equity multiple, is it cash flow, is it long term, is it short term, and are they different enough that it allows you to completely diversify? And a development multifamily program or project in Phoenix is probably not going to be correlated to a investment that's grape farming in Texas. So two very different investments that allow you some true diversification, even within one sector being real estate.
How many groups are you raising for at one time?
Usually 4 to 5.
Wow. And so you're in a very unique niche in the raising capital world. Something that, I don't know if the audience, if you guys haven't picked it up, obviously he's made his expertise raising money for deals for people who have really good deals. And if you didn't pick it up, it's not just real estate, right? He's also doing a vineyard. And so explain a little bit of how you present, because it would be difficult in my head to go, well, I have 5 deals, and how do you fill all 5? Now, do you just present the deals to your investors and they get to pick and choose? Or do you direct one to one that you think that they're suited for? How does that work?
Yeah, so if you just present all 5 to, a brand new potential investor who thinks they may want to put some money in real estate to diversify from the stock market, which obviously this is a great time because stock market has been down for 2 years. It's finally back up. Most people are back in the black, and it's a great time to take a little money off the table and diversify into real estate, which happens to be down right now. So, it's a fantastic time to diversify, and a lot of folks are reaching out that don't know anything about investing in real estate. So I'll just go through the discussion that we just had, about equity multiple versus cash flow. Where are they in what season of life are they in? Or are they, do they have a spouse that's going to quit the job and have children, and maybe they need a little cash flow? Or are they both working hard and there's another 15-year run before they go into retirement? They obviously, would be better off with an equity multiple type of investment. And then finally, what are they interested in? Is it kind of cool to be part owner in a vineyard in Texas? If that gives you enjoyment, then that's a lot better than investing in the stock market, which never gave me any joy whatsoever, right?
Yeah.
I like to not present all 5 of them at one time unless they have a little bit of experience. I mean, mention them a little bit, but for them to bite in and chew on all 5 of them at one time is a little overwhelming, and I think some people just throw it all up in the air and run out from under it. So yeah, we have that discussion, and then I kind of direct them to the one investment that would seem to fit their goals the most, and then try to break that down enough to where they can understand it, and then let them go watch the webinar, and then we get back on the phone and talk again if it's something they want to move forward with. But and a lot of folks out there just want to pick the one investment and put a lot of money in that, and I discourage that approach. I mean, it's hard to always know for sure which pony is going to win the race. So you're better off to just do a good job of vetting them. And so when I vet a investment, I'm looking at the team. I want to know who they are, what they've done, what's their track record. I want to know what's happening with the property. Does it have a lot of upside? If it's a value add, where is this coming from? How are they doing it? Are they dependent on the market to give them that lift, or are they actually pulling levers to make things happen? And then finally, where is it? It's just in a growing area, or is it shrinking? Do they have good political actions in the area? And money goes where it's treated well. So if everything's lined up appropriately, where they're stimulating job growth, and the data suggests the same, then you would anticipate moving forward that's going to be a good place to have an investment. So if you can check all 3 of those boxes, the team, the property, and the location, it's got a pretty good chance of doing well long term. And then I advise my people not to try to pick the one single thing, but if they have $500,000 they want to invest, unless they find something that's just for sure what they're looking for, then divide that up into 5 different deals and diversify it. There are times when people just find the deal, right? So I mean, if you find a pref equity type of investment that's shorter term, gives you great interest rate and low risk, and that's where you want to park $500,000, then that's a little different. Now you found the real deal that you want. If you don't know for sure what you want, then you're probably better off to diversify in some uncorrelated investments that give you some true diversification.
Hey, Tyson, when you're meeting with folks or investors, are you meeting with one or two at a time, or are you like, for example, my buddy's got, I think, 10 or 12 dental offices now, and as they continue to develop, they give them the opportunity to invest in that. Is that something that you would be interested in doing? Getting in front of 50 dentists and kind of pitching what you have, or giving an overview of your company, or is it more individualized attention?
No, I'd be definitely interested in doing that. We do some webinars and some of that type of stuff. Sometimes for pitching deals, sometimes just educational, and most of my conversations are one-on-one. People just reach out to me through the website and set up a call, and we'll jump on a call and kind of figure out where they are in life and what they're looking for and what their interest level is, and try to direct them down the right path. And as you know, some of these deals are 506C offerings, so they have to be accredited, whereas other ones are 506Bs where they don't. So spend that first 30 minutes just kind of figuring all that out, so we know what road we could potentially go down with them.
Can you talk about briefly a little bit? A lot of people aren't going to know what 506B and 506C mean.
Yeah, so that's a type of syndication. If it's a B, it's set up as family and friends, and Security Exchange Commission set that up basically to allow the normal people, if you will, to get involved in private real estate. And if you look at the majority of money that's getting pumped into private real estate, a lot of that's coming in through family offices and people that have advisors that just work on a different level than your average person gets involved with, and so they have exposure to a ton of private real estate deals. And if you look at the allocation of those sophisticated investors, and let's say maybe 30 million and above, they're probably allocating somewhere around 25-30% of their net worth into private equity, including private real estate deals. And actually, if you look at private equity in total, probably that average is closer to 50%, and about half of that, or 25, would be in private real estate deals. Your average investor in anywhere close to that. And part of the reason is access. And at one time, when the only option was a 506C, you couldn't even get into them legally until you cross that barrier. So they define a accredited investor who can get into a 506C, someone who's making $200,000 a year, or if they're filing jointly with a spouse, then it is $300,000 a year. And supposed to have done that for the past 2 years with an expectation of moving forward with the same. So, that knocks a lot of your average people that are in the stock market, out of those deals. And if you don't have that revenue stream, you can also qualify if your net worth is $1 million, not including the house that you're living in. So going back to the 506B offering, which is for friends and family, that allows that other sector access to what they would not have otherwise. And that first 30 minutes of the conversation just allows me to get to know the investor and kind of discuss about these things and see, where they're heading. And some of my investors are young physicians, and they haven't been out very long, and they don't have that track record yet, and they can't qualify for a C. So we might have to get them into a B for the first year or so, and then when they do qualify, then you can move them into the C investments as they come along.
Yeah, there's a certain piece to where when you're reaching out to people, right, with the 506B, you can't, correct me if I'm wrong here, you cannot post on a social media platform to try to raise capital. It has to be friends and family.
Correct.
And the 506C, You can post it, but they have to be accredited making over 200,000 a year, or 300 if they're with their spouse, and then they can invest on anything. But is there a limit to the numbers that they're allowed to invest between a B and a C?
Yeah, so there's some rules with a B. I think it's limited to 30. I might be lying to you a bit, but somewhere around 30 of the unaccredited investors. So,
Okay.
you can take, if you're raising for a B, you can take accredited investors. The nice thing about bringing an accredited investor into a B offering is there's no limit for that one. So you're only limited on your non-accredited investors.
Mm.
And sometimes that makes a difference, because we'll occasionally run into an investor who really wants to get into a deal, but they don't have the minimum. So typical minimum for these types of investment would be $50, $75, or $100,000. And for a 506B offering where non-accredited investors can get involved, it's not uncommon for that minimum to be 50. And I'll occasionally run into somebody who really, really wants to get involved, but they can't because they don't have the minimum. And so we'll do one or two things at that point. I'll just reach out to the lead GP and see if they'll allow them to come in at 25 or whatever the number is. And sometimes they'll allow that. But the problem you can occasionally run into is if they're already maxed out or getting close to maxing out on the number of the non-accredited investors that they can take into their deal. If they have plenty that are coming in with the 50 minimum, and you have somebody that's coming in at 25, they're going to get bumped out. So your lower investors are the ones who get bumped out of that deal if they reach their max.
There's two parts that I want to talk about here from two perspectives. If someone out there wants to get into your niche and start raising capital for other people as a form of getting into real estate because they have the network, right? How would you go about that starting off? Like, do you just start making phone calls to your network? Because not everybody's going to be able to post up a webinar. I know that's not how you did it, right?
Yeah.
So what would you have to say to that for that perspective?
Well, two things. One, you just have to start letting people know what you're doing. And like I said, these things sell themselves. You don't really have to sell them because people are looking for good investments to get involved in. So, that's one thing is just, letting people know that you're involved in that and that you have opportunities, and just have conversations with people. One really important thing is, you have to make sure you get into good deals. So it's super important that you wind up with a good team that's experienced, it's got a good track record, spend the time to vet the property and, make sure that that's a good, solid property and it's in a good location. And, if you're bringing good deals, they're not all going to work. And Danny brought this up earlier, and I didn't touch on it, but some of these deals are not going to work. And, you have to have that right mindset going into it. It's okay to fail. You just, don't fail big, and make sure that you mitigate your risk. And, I was listening to a investing audio book last year, and they were talking about art buyers. And apparently when these art buyers will buy these large portfolio of art, roughly 95%, at least according to the author of this book, are 95% of the art's just worthless. But it's the 5% that hits that makes it work. Thank God real estate doesn't have that failure rate, but some of them are going to fail. So, I'm in 40 different deals right now, and I've got two of them that are a little upside down. So, maybe 5% in my experience. I haven't had any capital calls from the groups that I'm involved with, but it could happen tomorrow, and if it does, I'm not going to cry about it. But you have to make sure your investors kind of understand that going in. And it goes back to what I mentioned earlier. If you have $500,000 that you're going to drop into private real estate to diversify your portfolio, don't try to pick the winning pony and put the whole thing on it. Pick 5 winning ponies and mitigate the risk.
I guess with every investment, right, guys, you gotta know what the hell you're doing. Look, do the research, vet the deals. Before you put any money into anything, right? It's an investment, and it can always go south no matter how great and beautiful it looks. So the second part I want to ask is on the other perspective, right, from the investment and the team side. How does that deal structure look with you bringing in capital and being part of the GP deal? Do you mind talking about that for a bit?
The structure for the GP?
Yeah, like for you, that you bring all this money in for these deals, how do you structure your part into a deal like that with the group that found? Well, you got the acquisitions piece, right? So it's the group that found the deal, that are the operator. They're putting the deal together, and then they bring you in as part of the team as the guy who's bringing in the capital, making sure that they can buy the damn thing. So how does your piece look, and how do you structure that deal? Like, do you negotiate a piece of equity? Do you just get a payout for it? Is there an acquisitions fee? Like, how does that all look from your perspective, if you don't mind talking about that?
Yeah. So number one, I always invest in the LP end of it as well.
Okay.
So, probably half of my investments in real estate are strictly limited partner, which means I'm on the passive side of the deal. And, roughly half I'm on the GP team as well. But even when I'm GP, I'm still investing in the LP side of it. So, my money is going into the same limited partner bucket as all my investors. And, I think it's important that, when you're picking teams to get involved with, you want to make sure that they're investing in their own deal and have some skin in the game. But as far as the GP end of it, usually the capital raise winds up being, roughly a third of the GP ownership. So on your typical multifamily deal, that would be a third of 30%. Because it's usually a 70-30 split, not always, but frequently. So the GPs are the guys that are finding the deal. They're putting their own money up at risk as they're doing the due diligence, which they may lose if something falls apart on the deal. And then, of course, they're running the show and dealing with the tenants and toilets and making sure the work's done. So they're pulling 30% on the typical deal, typical multifamily deal anyway. Whereas the limited partners who are bringing the capital, they're risking the capital. So the GPs are at risk for more than that because they're signing on the loan. They've got their money up for, as they're going through the due diligence process, and limited partners come in. And assuming that they get enough capital to close the deal, then the limited partners immediately own 70% of the deal. And then there'll usually be some type of pref, which Dan brought up earlier. So that's a preferred return. That's the first money out of the profits every year. So, for instance, if the deal is paying a 7% preferred return, first 7% of the profits every year would go to the limited partners or the investor. And after that, it would typically break down to a 70-30 split, so that 70% of every dollar that profits in any given year is going to the investors or limited partners, and 30 to the general partners who are actually running the show and doing the work. And then some of them, this is referred to the waterfall, and how does the money fall as the profits come in? Some of them will have a second split. Maybe the second split is at a 15 internal rate of return. It breaks to a 50-50, so that of every dollar profit after they get to 15% IRR, it goes to 50-50 split between the general partners and limited partners. Another important thing is the limited partners are really only at risk for whatever capital they put in. So if you put in $100,000, that's what's at risk. Now, there's a risk you could get a capital call, but you don't have to do that. So, some people prefer to, jump in on the capital calls and continue investing. And other guys will say, I'm not going to throw good money after bad, and they don't. But fortunately, capital calls are not all that common. They're happening out there right now because of the economy and the interest rates. And a lot of folks have gotten into trouble with the variable rate short-term loans. But most of the ones that are struggling, at least in my camps, are struggling to the point to where they had to stop distribution, so they're not cash flowing, but they still have their head above water. And the thing to remember, about these types of cycles, which is not a true cycle, but a Fed-induced cycle with the interest rates, if you can get through to the other side, these deals that are upside down are more likely than not going to be fine. But you do have to ride through, and it's we're definitely in winter right now, and everybody's hoping the interest rates are going to start coming down and save some of these deals that aren't doing well. But we'll find out soon enough.
Yeah, I mean, that was a lot there, right? So basically, we're saying you have the general partners, which are the GPs. You have the limited partners, which are the LPs. The limited partners are the people who are bringing in the money to supply the bigger deal, right? And the GPs are taking a little piece of it, which they take what you said, the 30%.
Correct.
So
Usually.
they have 30% ownership of the entire deal. So if the deal's 10 million, they have 30% of that, right? And then the limited partners who brought the money have the 70%, right? Okay, wanted to clarify that. So, and then you get your piece out of that 30%.
Correct.
For being a GP, for bringing capital in. Got it. Cool. So, man, I mean, we talked about a ton today. Dan, you got any final questions here before we're getting to the top of the hour? I'd like to ask our questions.
Yeah, I'll let you lead off with the first one, and then I'll go with the second one.
So, being that this is the Big Break Show, Tyson, we always ask every guest that we have on here, what's your big break? Is there a defining moment in your life that got you from old Tyson, right, from to where you were before to what you are today?
I think as you go through your life, you have different seasons, right? And you fight different battles in different seasons.
Yeah.
I think with respect to what we've talked about today, I think my defining moment and turning point was when Rod Cleef says you only have to be good at one thing.
Mm-hmm.
And a light bulb went off, and, I knew what that was at that point. And honestly, I would have never guessed that going in because, I just didn't want to be asking people for money. But, raising capital is not really asking people for money, but rather just providing opportunities to invest in a lot better returns most of the time than what you get in the stock market. So these deals sell themselves. But yeah, that was a turning point for me. Just figuring out what lane I needed to go down because before that, I was in a lane that wasn't working, and I was struggling to learn all aspects of it. And as Rod said, I mean, you want to try to learn it all. It's important you understand it, and you never know what you're going to be able to contribute to. We've talked about the property we have in San Antonio that I'm on the GP team with, and I just developed an interest in the bulk Wi-Fi and reached out and did some negotiations with that. And just by something as simple as providing bulk Wi-Fi, we added over $80,000 of annual revenue, which is going to bump our exit at about $1.5 million. So,
wow.
You can create revenue out of thin air if you just study the opportunities, and just a lot of it's just learning from other people, right?
For those of you that don't know, in multifamily, the opportunity to raise the value of a property, it comes in correlation with the revenue that the property generates. So what he's saying is because of the internet that you added, it raised the value significantly by adding that revenue to the property. Am I understanding that correct?
Yeah. So the way that works, the company that that we wound up partnering with had 20% penetration. So this is a 200-unit multifamily. So they had 40 different clients. There were tenants living there, and I think the average rate that the tenants were paying was $70 a month for the Wi-Fi. So we come in and we sign an agreement with the provider for 100%. So now they go from a 20% penetration to 100% penetration, and they don't have 40 clients they have to deal with. They have one.
Yeah.
So we write them one check. It simplifies their life. They get 100% of the deal, and in doing so, they give us a fantastic break. So this particular one, and obviously, depending on where you are, you're going to negotiate what will work. But we're paying $30 a door,
Wow.
which gives us $40 delta, and then we trim that back to make it more appealing. So we're probably going to go in, and we're actually implementing it even as we speak. We're going to go in at around 35, and we give them a free month. So the tenants don't have to do this in the first year because they already have an agreement signed with the seller who signed the agreement before we bought the property, and we just recently closed on this. So during the first year, we're going to incentivize them with a cheaper, better product than what they had because the signal is stronger than most of what most of them were paying for. And we'll do it cheaper, and we'll give them a month free. So that gets everybody on board, hopefully, in that first year. And then when they sign their lease, it becomes part of their lease.
Yeah.
So they don't have an option at that time. If they're going to live in our unit, Wi-Fi comes with it,
Yeah.
and it's it's just a set price.
Which is still cheaper than most places if you go out and get your own.
Yeah.
Like $35, even $40 is like significantly cheaper.
Yeah, it's a good deal. It's a win-win.
Yeah.
It's a win for the company because now they have one person writing them a check. They get 100% penetration. The tenant's actually getting a better product than what most of them had before at a cheaper price, and we're obviously winning with it with increased revenue and as you know, whatever that number is, net operating income. In this case, it's 80,000 plus. You just divide that by your cap rate, and it'll tell you what the actual value of that's going to be on your exit. And
Yeah.
for us, it's 1.5, which is it's a nice win for something as simple as internet.
And for those of you wondering what cap rate is, go back and watch the episode with Juan where he just broke it down perfectly and get a better understanding.
Well, the second question we've got for you, Tyson, can be from business or personal, but we want to know what's the best advice that you've ever received.
Oh boy, I think with respect to working with teams, it would be the same thing I just mentioned. The finding your one thing. I think with respect to making progress, it was a decision to join groups like we talked about earlier. I think with respect to life, my father instilled in me at a very early age to be disciplined and have a strong work ethic, and that's served me well over the years. I think the Bible teaches you a ton of important things, but one is it's better to give than it is to receive, and it's amazing how much joy you get out of life when you start living life that way. And I think with respect to relationships, it's putting the other person first. And again, I think in any aspect of life, more likely than not, the Bible and the Book of Proverbs will direct you the right direction if you just read it. And I think reading on a regular basis, Warren Buffett talks about that, and as a big reader, and I think it's so important. You just learn so much from other people if you just take the time to read or listen to audiobooks. If you're spending some time on the road or when I'm at the gym, I'll just turn an audiobook on and learn more about investing and learn more about health or whatever you want to move in life. You need to be taking in new information from people that have spent time studying it.
I think you're the first person to ever break it down that way in different aspects of right. Like I love it. It's great. I'm glad you did it that way. Usually somebody just give us like one quick phrase or something. So I appreciate you sharing that. We talked about this briefly the other night about, I think it was, there's this guy that I read a lot of and listen to a lot of his stuff, Naval Ravikant, and there's a thing that he says where it's like, read everything and anything until you love to read, right? And we talked about that briefly at the fire when we were cooking the other night. And same thing goes, because I brought this up because a lot of people are like, well, you just said that you listen to an audiobook at the gym. And people are like, well, I'm not motivated at the gym if I listen to an audible. I need to listen to some hardcore music. And that's because you've trained your mind to always enjoy that sensory, right, movement or whatever it is in your head to where you have to listen to music when you work out. But if you listen to enough audiobooks and podcasts and you learn to consume information, it ends up becoming a joy to do it at any aspect. I do the same thing. I love to listen to audio. Dude, I listen to them when I'm in the shower, for crying out loud. Sometimes I'm just like, I'll throw them on because it's so good. So it doesn't have to be a learning experience. It doesn't have to be a learning book. It doesn't have to be a learning podcast. Anything you enjoy, whether it's a crime podcast, whether it's a sci-fi audiobook, whatever it is, listen to it until you condition your mind to be able to truly appreciate and enjoy that to where you can start transitioning to other things that normally you wouldn't listen to. You know what I mean?
Yeah.
So
it's interesting. I hear the same thing that you mentioned about the music and doing cardio. And I think you're 100% right. I can get on the stair stepper and I'll usually mentally decide, how many flights I'm going to go to when I get on. And it's not uncommon that when I'm listening to a really good audio book and learning more about investing or learning more about something I'm interested in and wanting to advance, I'll look down and I'll be past that number.
Yeah.
Significantly past that number. And I don't even realize it because I'm just in just consumed by, this information that's going on in the audio book. But I think you're right. I think you have to condition your mind. I mean, if you're used to listening to a certain type of music or whatever, as you do your cardio, you'll have to retrain your mind to get involved in something else that's going to be more beneficial in the long run.
And I'm glad you brought that up because even with music, right? You have a mind, a number you have already set, right? I'm going to climb 50 steps, 50 floors today, and you got the music going, and all you're doing is looking at the number because all you're listening is to music, and the music changes, and you're looking at the number. Gosh darn it, I'm at 40, and you're listening to the music,
right? And you're dreading it.
Correct. As opposed to you're not even paying attention to anything other than what's going on, and you're like, oh shit, I'm already past this. Yeah, I appreciate you. That's so true, man. So give the listeners an actionable step that they can take the moment if they stop listening right now, something they can apply to their life. It could be about anything, life, personal. I mean, you've broken it down so great. So go ahead.
So I'll just stick with the topic at hand. When it comes to investing, if you haven't diversified your portfolio and added some private real estate, just do it. Just do it. And if you don't feel comfortable doing the due diligence, which is incredibly important, then join somebody that is comfortable.
Yeah.
That's the way I started. I reached out for some help with somebody that I knew the particular asset class I got involved in. And it's just like I tell my investors, I'm investing in all these deals that I bring to the table. Obviously, I've vetted them, and I'm happy to go through that process step by step with new investors. But, some of these guys that I deal with, they don't have time. They're living lives just like I lived before I moved into real estate and cut back my orthopedic time. And, they basically just get in deals that I'm getting in because they know that I'm vetting them. So you either have to vet them yourself or find somebody else that's going to vet them. I mean, ultimately, you want to do exactly as you said. You want to learn the industry, learn how to vet them, and just ask good questions. But in the meantime, just get in the boat with somebody else. But you got to get in the boat. You have to pull the trigger and do something. So, for the listeners that are wanting to diversify, that haven't done anything, put a time limit on it. 90 days, 60 days, and just start, reach out to me, reach out to other people, start looking at, different opportunities and just work through it and find something you're comfortable with, find a group you're comfortable with and pull the trigger, get involved.
I love that. Well, it's funny. Before we, Dan, you guys listening, a little backstory here, inside joke, I guess. When we talked about doing the podcast a couple of days ago, because we've been hanging out here for a couple of days, Tyson was like, I'm not very good at, I don't remember the exact words you used, but it came off as I'm not very good at speaking and talking in podcasts. So just try to make sure you do a good job continuing the conversation. I got to tell you, you're pretty damn good at it. You continue the conversation great.
Well, I'm definitely getting better. My son pushed me into doing these webinars, yeah. And I tell you, one of my first experiences, I was at a rodeo in St. Joe, Missouri, riding rough stock. So for those of you who don't know, it's bareback horses and bucking horses and bucking bulls. And so the announcer was doing a live remote, and he asked a couple of us to come along and so he could interview us. And so we sit down there and they hook us up and never done this before. And he's like, we have Tyson Cobb with us from Texas. And, he's riding tonight. Be riding bareback horse and a bull. He said, Tyson, tell us what you're going to do. And yeah, I'm going to ride a horse and ride a bull. And that was it. I didn't have anything else to say. Both of the guys broke out laughing. He's like, "Is that all you got?"
Oh, that's funny.
Said, yep, that's all.
Oh, no, you did a great job breaking stuff down today. I appreciate you sharing. And a big thing that why we have the podcast is we love to bring people that are willing to share. Not only is there so much misinformation out there, but there's so much good information being held in. People are stingy. They think that they can't share info, and you just gave a lot of info that. Literally, somebody can take this out right now, break it down, take some good notes, and start raising capital. And now we went over syndications. We went over how to raise money, the conversations to have, not to sell, right? But to offer. The numbers speak for themselves. I mean, and even how to structure a GP deal if you're going to raise money for someone. So I appreciate you coming on the show, man. This was fantastic. I'm so glad you did it. I know we've been trying to schedule it for a while now. Let everybody know how they can get a hold of you. We'll put it in the show notes for sure before we get off here.
Yeah, so you can find me at timberviewcapital.com. And, we have a playbook on there for primarily structured for physicians, but it doesn't really matter whether you're a physician or not. This is just for people that want to learn more about real estate investing. And you can go to our portfolio, see the kind of deals that we've invested in, and then go to our current offerings and see what's available. And the only thing that you're not going to see on the website would be the 506Bs, which are set up for non-accredited investors, as we discussed, because we don't advertise those. So the only way you're going to get to see those is to jump on a phone call with me, and you can schedule a phone call through the Calendly link that's on the website. And again, that's timberviewcapital.com. And
And follow him on Instagram. I've been trying to get him to be a little bit more active on that. So we'll put everything on the show notes, dude. I appreciate you coming on. Dan, any final thoughts, brother?
Dan, great seeing you. All right. Bye-bye.